Here are 10 dividend stocks that are favourites among dividend investors looking for passive income. Some of these are better than others in my opinion, but let me know which is your favourite in the comments below. The first one today is Coca-Cola, ticker symbol KO. This is of course a global leading beverage company, and they are known not only for their consistent dividends but also their increasing dividend payout year over year. If you're a shareholder in Coca-Cola, you will get paid a dividend 4 times a year. These will come in April, July, October and December. The dividend yield is 3.3%, so it's not the largest on the list today, but it is still a very, very good company and a lot of dividend investors love this one. So here we are on Seeking Alpha. Now Seeking Alpha Premium is my preferred platform of choice for all of my stock research and the one I actually use every single day, multiple times a day. They are currently offering anyone watching this video that uses the link in the description below a 7-day free trial plus a 30% off deal as a New Year sale. So we're going to look at a few things here. But firstly, I just want to draw your attention to this ratings summary on the right hand side here. We can see that both Seeking Alpha analysts, Wall Street analysts and Quant are all saying that this is a buy or a strong buy right now. We could have a look in the financial section and just have a look at how their revenue has been increasing each and every year by the looks of it, which is a very good sign. But obviously you do need to look into this in a little bit more detail. So straight away here, I can see a dividend summary and my eyes are drawn to this dividend growth section. So this means that Coca-Cola have been able to increase their dividends consecutively year after year for 61 years. This means that they are known as a dividend king, the highest that you can get as a dividend paying stock. So these are companies that dividend investors can really trust because these are the companies that are reliable in paying a dividend. But not only reliable, but they're also increasing the dividends year after year. If we just now go to this dividend growth section and we scroll down, we can expand this graph out to a 10-year period, or you can just see all of the dates here and how much it's increased by every single time. Such a phenomenal company when it comes to dividend increases. Over the last 1 year time period, Coca-Cola has actually underperformed the index and they've not returned positive returns to investors, which is a little bit of a shame for such a strong company, but this does happen. Remember, the macroeconomic situation will play on different companies differently. And even over the last 3 years, Coca-Cola is only up by 8.87, again underperforming the index over that time period. And this is because actually we've had a lot of macro stressful situations for companies like Coca-Cola in the last, 1 to 5 years. We've of course had COVID, which Coca-Cola took a hit way harder than the likes of Pepsi, for example, because they didn't also have that food offering in their portfolio to soften the blow. And then of course we have been through a period of high interest rates, which should be coming down this year. Although Coca-Cola is a very traditional company that has been around a very long time, they are keeping up with the times and actually they are looking for different ways to integrate artificial intelligence into their business. So maybe we can expect quicker growth in the upcoming few years. The next one is Realty Income, and this one has a place in most dividend investors' portfolio because this is one of those companies that pay each and every month. They have a global portfolio of over 13,000 properties and grocery and convenience stores actually make up 20% of that portfolio. On the dividend summary page here, we can see that their forward dividend yield, is 5.36%. So for a company that is paying each and every month, and also look here, they have grown their dividends for 26 consecutive years, you can start to see why this company is so liked among dividend investors. They've scored very, very good on Seeking Alpha's dividend grade scorecard. You can see dividend safety coming out as a B, dividend growth a B+, dividend yield a B-, dividend consistency an A+. So very, very good all round. And the rating summary over on the right hand side here is buy, hold. So could be a good opportunity to start buying in and adding more shares in this stock if you have done your research. Realty Income is a REIT, a real estate investment trust. And over the past few years, they have not been doing so well. And if you look here, they've actually been underperforming the index. And that is mainly due to how impactful interest rates are on real estate in general and real estate investment REITs. And with high interest rates that we have been seeing, Realty Income and other ones that we'll see on the list later in this video have been struggling a little bit. However, lots of investors have actually been using this time period to accumulate shares, because now we are entering into maybe lower interest rates, a better macro, more favorable environment, because remember, the macro is always cyclical, so these times do come and go. And actually, companies like Realty Income and therefore their stock may see better times ahead. Next up, we have ExxonMobil. Now, I'm sure you've all heard of this one before, but of course, they are a leading energy company. You can see here that their forward dividend yield is 3.8%, and they are a quarterly dividend payer. They pay out dividends in March, June, September, and December. What you can also see is that the dividend growth is saying 25 years. And if we go onto the dividend growth tab and we scroll down, we can see this all listed out, that they have been increasing their dividends for many years in a row. However, the data on this website only goes up to 1995, and actually, this company have been increasing their dividends for 41 years in a row. This means that investors know that this company is reliable. So those looking to build a passive income from their portfolio don't have to necessarily worry as much with this company that they are just going to cut those dividends. Over a 1 year period, negative 8.44%, underperforming the index, but we've only got to zoom out to a 3 year period and we can see that the returns have way outperformed the index, 142.26%. And like with many companies, these sort of stocks do tend to be quite cyclical and very linked to gas and oil prices, so something to keep an eye on. The next stock on our list today is T. Rowe. This is an investment management company. Their forward dividend yield is 4.53%. Remember, it is not good to only base your investment decisions on dividend yield alone, because the companies that have a very, very high dividend yield are often those that are unreliable and can just cut that dividend at any given time because they are maybe using that as a way to lure investors in. I'm not saying there aren't companies out there with a high dividend yield that are also reliable and very good companies, but just do your research. They are also a quarterly dividend paying company, as you can see here, and they pay out in March, June, September, and December. And they have a dividend growth of 37 years, again indicating that they are a very reliable dividend company. And let's just have a look here. Compared to the S&P 500 over the last 1 year time period, this company has actually underperformed the index, returning investors negative 3.27. But that is why long-term investing is so important, so that you can see the ups and the downs. And over the long term, if you are invested in a decent company, a good, intrinsically valuable company, you would expect the stock price to go up over time. But of course, looking year to year, it may go down, it may go up, it could be volatile. And it does depend on your aim and your strategy, because you can see here that over the last 3 years and 5 years, actually, this company has underperformed the index. So maybe investors that are more aimed towards dividends, passive income and dividends, rather than the stock price growth, would be interested in this company. But again, just do your own research. Next up is Diageo. Now, this is a company you may not have heard about before. However, I can guarantee you have heard about all the brands that they own. They are a British company, but actually a global leader in alcoholic beverages, and they have such a diverse portfolio. Their dividend yield is currently 2.9%, which is not the highest on this list, and actually the last stock that we talk about in this video will be the highest dividend yield that we cover today. But you know, like we keep saying, dividend yield isn't necessarily everything, and you can see that they actually pay their dividend type of payment is interim, meaning they pay twice a year. And those dividends get paid in April and October. And like with many companies on the list today, because I purposely picked companies that are more of the reliable dividend payers, this company also, Diageo, have been able to consistently increase their dividends year after year after year. When we start looking at their 1 year performance, it hasn't been all that great. You can see it down by 21.80% in the last year alone. And the stock market is currently open in the UK, so this could change as I'm recording my screen here. But yeah, not a great time. And that is just because of interest rates, rising cost, a cost of living crisis, supply chain issues that they've had. Many things have hit them at the same time. However, this is one of those companies that over the history of their existence, they have shown to be recession proof. They have shown to come back year after year, even after economic difficulties. And if we expand out to a 5 year period and we max it out, you can start to see that actually they have had periods of time where they've done extremely well, and they could be about to enter one of those times in the upcoming few years again. No one knows, but something to think about. Next up is Apple. Now, although this isn't a typical dividend stock, and actually it's more of a tech growth stock, they do pay a dividend. It is a very small dividend. However, they do pay one because they just have so much cash, they don't know what to do with it. They have a forward dividend yield of 0.5%, which is the smallest, I believe, on our list today, and they pay out 4 times a year in February, May, August, and November. So if you are investing into this company purely for dividends, it may not be the best company for you. Having said that though, they are one of those companies amongst all companies in the world that actually give some of the best returns to investors. So what you could look to do is actually get a mixture of both. You could get a small dividend payment from Apple, and then you could look to sell some of the profits over the time that you're holding it in order to supplement that dividend income if dividend income is your primary focus. But of course, for those investors not actually looking to live on the dividends or on the money from their portfolio, they're not in that retirement stage yet, you may not actually want to start selling the shares of Apple, and you may actually decide to accumulate them and be okay with a smaller yield. So this is telling us that they have had 10 years of consistent dividend growth, but yet their dividend growth comes out as an A+, and this is because it's rating the attractiveness of the dividend growth rate when compared to peers. And actually many of Apple's competitors don't offer a dividend because they are those high tech growth companies that are reinvesting all of their money back into the company rather than paying a dividend out to investors. Over a 1 year time period, Apple has completely outperformed the index, 48.55%. We know that some of these really high growth stocks have had a phenomenal last year. 3 year period, again, outperforming the index. 5 year period outperforming the index, 10 year period outperforming the index. You can just see how powerful the growth of this company has been. Next up on our list today is Vici Properties, another REIT, a real estate investment trust. This company owns one of the largest portfolios of gaming, hospitality, and entertainment destinations. And they actually have 3 of the most iconic facilities on the Las Vegas Strip. Their dividend scorecard is looking very, very strong. All greens down here, B-, A-, B, and B. And you can see that their forward dividend yield is 5.21%, and they pay 4 times a year, again in January, April, July, and October. We can see here that they've only been able to increase their dividends for 5 consecutive years. Of course, this isn't as high as the likes of Realty Income, so definitely some further digging needed there to see if there is some issues happening or whether that is for a very, very benign reason. Similarly to Realty Income, just with the macro situation, high interest rates, not been very favourable for any REITs or real estate in general. Over the last 1 year, underperforming the index. 3 years, not so bad actually, pretty much matching the index, 26.21%. Changing sectors for the next stock on the list today, and that is Medtronic. They are a key player in medical technology. On this summary page, I am seeing 2 buy ratings and 1 hold rating. Going over to the dividend page on the scorecard, I'm seeing a little bit of a mixed scorecard, but all in all, looking quite strong. Forward dividend yield of 3.35%, dividend growth 10 years. So again, not crazy amounts of years that they have been able to grow their dividends, but still very impressive. And this company are paying investors dividends in the months of January, April, July, and October. Just having a look at their revenue on their income statement, just out of interest, it looks to be going up slowly over time, but definitely has had some years, 19 to 20, you can see where it has actually gone down, and it hasn't been growing at a very rapid pace. And I'm guessing if we look at the growth here, yeah, you can see that. So revenue growth year over year been rated a C, 3.74%. Forward growth not looking great as well, a C-. So just some digging to do before adding to this one to your portfolio. Over the last 1 year period, 5.87%. 3 year period, down by 28.72%. So way underperforming the index. 5 year period, not that great either. 10 year period, again, way outperforming the index. So again, this might be a company that actually, investors want if they are focused on dividends specifically, as there doesn't seem to be as good growth here as some of the other companies we've looked at today. The 9th dividend company on our list today is another really well-known company, and that is Pepsi. Pepsi are, of course, a major player in both the food and beverage industry with a very diverse portfolio. I'm seeing quite a lot of buy ratings here, but let's just go over to their dividend section. Dividend card looks pretty strong, but what I am seeing is 51 years of consecutive dividend growth. This means that they also get the title, like we saw with Coca-Cola, as being a dividend king, which is the best that you can get. But Then again, their dividend yield, their forward dividend yield isn't that large, 2.98%. So you are going to have a lot of money invested into this company in order to get a substantial payout. Paying 4 times a year in January, March, June, and September. Revenue looking pretty strong, seeing some solid growth year over year. And if we go to the growth section, yeah, we can see that here. Revenue growth year over year rated as a B, pretty good. And revenue growth forward rated as a B, again, pretty solid. Let's just see how Pepsi has been performing compared to the S&P 500. Not that great over the last 1 year period. Again, like we saw with Coca-Cola, macro impacts, interest rates, high cost of living, etc., etc. However, Pepsi over the last 1 year and even 3 years, the blow has been softened a little bit because they do have the food portfolio within their entire portfolio. They're not just concentrated on beverages like Coca-Cola is. And the last one on our list today to round this video off is Altria. They are a company in the tobacco industry. They have a pretty high forward dividend yield of 9.72%. So one of those companies that are offering quite a substantial amount of dividends out to their investors. And again, dividend growth, phenomenal here. 54 years of consecutive increases. So not only are they offering a very high dividend yield, but they are also backing that up and showing investors that they are reliable. They are not just cutting their dividends some years and increasing it, then cutting it back and then cutting it all together. They are able to consistently increase their dividends. However, when we start looking into their income statement and their balance sheet, we can see some potential issues here. For example, their revenues haven't been growing very strongly, and actually they've been a little bit all over the place. And this could just be the pressure on the industry itself. What we've just seen is backed up in this growth section here, revenue growth not doing too well year over year or forward. And let's just have a look at how it has compared in performance. Over the last 1 year, not very good, negative 12.06. 3 years, again, not great, really stagnant actually. If you were an investor 3 years ago and you still are today, you would have got them nice dividends, but you wouldn't have seen very much growth in terms of the company, in terms of the stock itself. Now, I'd love to hear your thoughts. What are your favorite dividend stocks? Which ones do you think are the best? Stay tuned for the next video, but until then, keep analyzing, keep investing, and don't forget to hit that subscribe button.